good morning, everyone. So today we're really looking forward to presenting to you on enhancing or improving returns on cash. So today we have with us some very esteemed speakers. We have the Chairman of our Investment Committee, Mr. Mark Johnson. We also have Laura Ryan from Ardea and also Alex Stanley from Ardea. So today's presentation has been born out of some of the challenges that clients have been facing with respects to enhancing returns on cash. And over the last few weeks, we've been doing quite a bit of work on thinking through how it is that we can start to improve those overall returns. So the first presentation today from Mark Johnson will be talking about this concept of cash sleeves. So essentially looking at the different ways that we can manage outcomes and performance through different duration and risk profiles. And part of that process does actually incorporate us producing a recommendation in the next couple of days for clients about how Ardea fits as part of that process. So once Mark has presented for us on the overall bigger picture, we'll then move into a presentation from Laura and Alex, and they will cover off their past performance, the future, a bit of context about where they see markets at the moment and where their confidence levels are about delivering enhanced returns over the near term. So that's our running sheet for today. One thing I did want to make sure that I highlighted for everyone, if you do have some questions, which we will have time for at the end, please take the time to note those questions in the Q&A tab. That will definitely, and then I'll raise them, and depending on who's the most qualified to answer that question, we'll then divert those queries those ways. So please jump in. Don't hesitate to ask any question. No such thing as a silly question in this area. And clearly, the outcomes that we're wanting to drive from this is to improve everyone's understanding of this fixed income space, and cash space, which can be a little bit complex. So, without any further ado, I'm going to hand over to my esteemed colleague, as I said, Mr. Mark Johnson, Chairman of our Investment Committee, to start to present on the macro theme about how we're looking to manage these outcomes for clients. So over to you, Mark.
Thanks, Simon. Just bear with me while I share this screen. Hopefully I get this right. So I guess just in terms of getting started, we need to deal with the formalities and the disclaimers. So just making it clear to everybody, this is presentation contains general advice and doesn't take into account anybody's personal objectives or situation. Just in terms of today and what we're going to run through, so we're really, I guess, focusing on the defensive portion of clients' portfolios, and we're all too very well aware of cash rates, but we'll talk about that a little bit more. But we're conscious of people having money in cash and it being a poor return. So that I think most cash management accounts across the market are paying around 5 basis points. And term deposits these days, which has probably been traditionally the go-to place to extract a little bit more money from cash, are still relatively poor. With most of them sort of around 0.5%, and you can get a little bit better on some term deposits of maybe 6 months at around 0.7. But I get the purpose of today is to see if we can do a little bit better than that. So just in terms of framing up where we've been and where we're going. So as I said, there's no great secret that returns have been poor. And we're faced with conditions in the market where there's a lot of uncertainty, and investors are probably, generally speaking, there's a little bit unsure and don't have a lot of confidence in markets in terms of taking on too much risk. And then, so we're just looking at a few different alternatives today. So the first part of this session is just really looking at where interest rates are and giving that sort of some context. So earlier this year, when the pandemic came in or hit, interest rates, official cash rate was sort of around the 0.75%, or was 0.75%. and the RBA acted pretty swiftly to get the cash rate down to 0.25%. In order to stimulate some activity and just help those who are carrying a bit of debt. So, interest rate cuts great for people who have got a mortgage and they've seen their home loan interest rates come down to the low 3% range. But unfortunately for a lot of our clients, it's just another reduction in income. And unfortunately, I'm not bearing a lot of great news in terms of the outlook for interest rates, because I think the markets are telling us that that interest rates are going to be lower for a little bit longer. In fact, if we look at this orange line here, the market's assigning a 50% probability to a further cut in official rates down to around 10 basis points. Again, that's probably just reflecting the pandemic, both here and globally, and how it's impacting the economy. So in addition to the RBA's move in March, they also took an unprecedented move to step into the longer term rates, and stepped into basically move the 3-year government bond rate down to 25 basis points. So keeping short-term interest rates at the same as cash. So they've done that by literally moving into the market and setting the price at that level. And they've also said that they expect to do that and maintain that position until the RBA can see some progress being made towards their goals of full employment and inflation. And we know that unemployment rates has crept up, and maybe it's artificially low at the moment, around 7%, just due to some of the JobKeeper payments, and inflation is well off the targeted range of between 2 and 3%. So until those things improve, the RBA has told the market that they're stepping in and will keep those short to medium term rates pretty low. In fact, they have also suggested that they won't do anything with the cash rate until they remove that 25 basis point target from the 3-year bond rate. So there will be some signs of movement, but the bottom line here is that interest rates are not going to go up anytime soon. And particularly in this environment where, we've been advocating to hold a little bit of extra cash because of concerns about the economy and market volatility. It just makes things a little bit tougher. In terms of, if I got that right, so real returns on cash already negative. So this chart again is not meant to be too much of a dampener, but just highlight the facts that in terms of real rates, real interest rates, and by that we're talking about the effect of inflation on your returns. So if we suggest that inflation in recent times has been running around 1.6, 1.5%, and cash rates have been pretty low, and you can see here with the cash management account that the real return's sort of been around that 1.5%, and more recently with term deposits that's dipped down to be negative. So I guess part of our role is to look at things, opportunities in the market where we can do a little bit better than that. So looking at alternatives, but being mindful that we don't want to take on too much additional risk. Just to the next slide. So managing cash objectives, and as Simon sort of alluded to previously, cash sleeves. So I guess the way we think about cash, and if I maybe just redefine the sleeves into sort of more common language. So in terms of cash, it can hold cash for multiple reasons, but essentially for working capital. So we want to have money available to pay the bills and to make sure that, you know, the day-to-day things are taken care of. So we call that, you know, short-term liquidity. We want a certain amount of cash, whether it's in a self-managed super fund, that's sufficient cash to pay out pension payments. But I guess the key to that type of money is it needs to be available. It needs to be at call. So, you know, those kind of that money ends up in at call accounts or you know, maybe in a rolling 3-month term deposit or something like that. And the other sleeve that we refer to when we're talking to cash is that money that's sort of tucked away for a rainy day. So you don't need the money now, but you know, I guess it's that sleep at night money where you've got it there. If there's a cash need that arises, you don't have to sell anything. You've got cash available. So for that type of investment, we don't need to have daily liquidity, and we can sort of look out a little bit further and generally think that that's medium-term liquidity. We don't need the money for 6 months, and you know, we've got our working capital put aside for the cash needs, and this money's there in case we've got any type of shortfall. This slide here is really just, I guess, putting that into some kind of visual context, that 6 months and then 6 to 12 months or longer, in terms of, you know, want that liquidity, and then you've got the longer term aspect of holding cash. And then we're just looking here at basically some ideas and some improvements in services that we've got and can make available to clients. So that first sleeve of having money that's available and accessible, we want it within 6 months, short-term liquidity bucket. Macquarie Cash Management Accelerator account. So all of our clients will have a Macquarie cash account, and that Macquarie Cash Management account has been paying 5 basis points. And we've sort of been talking to Macquarie for a long time, saying, you know, we will look at other measures to increase return on cash. And after, you know, not saying it's all of us, all our at our request specifically, but pleasingly, they've now got available what they're calling their accelerator account, which does pay 90 basis points, which is in relative terms quite attractive, more attractive than term deposit rates, obviously more attractive than the cash management account rates. And the key feature, I guess, with the accelerated account is that it is linked in to the CMA, and it allows for real-time transfers. So that becomes, you know, a bit of a value add when we're looking to move money out in a pretty quick fashion. So we don't have to wait for overnight transfers. We can just get it back into that CMA pretty quickly. And as Simon alluded to, we're looking to have a note out to clients, hopefully later in the week, which will talk about the process that's required to get that established, which is all pretty straightforward. It's an online account, and the process for getting that account set up is all done online. So it's not too challenging. We don't have to wait on Australia Post. We can just get that done online, which is handy. And the other fund or other investment that we're sort of flagging today is more for that type of cash that's that you don't need for at least 6 months and maybe a little bit longer. And this is the cash enhanced fund, the Ardea Real Outcome Fund. So I guess when it comes to sort of mentioning it in this particular segment and in this context is, so the Ardea Real Outcome Fund, which Laura and Alex will talk about in a lot more detail a little bit later, it's a relative value fixed income manager targeting low volatility returns exceeding cash and inflation. And importantly for us, it carries minimal duration risk, which basically is saying it's less exposed to any any spikes, I guess, in global interest rates, which takes some of that risk out of the equation. In terms of how it's performed, like all managers, they perform better in different market conditions, and Laura and Alex can talk to that a little bit more later. But over the last 12 months, the fund's returned a bit over 5.5%. And importantly, for people looking for an income, over 4% of that was paid out by way of distributions, and they pay theirs on a quarterly basis. So a reasonably regular income flow, which is handy. And if I'm looking a little bit longer term, since inception, which is 2012 for the fund, they've had annualized returns of about 4.5%, and outperforming its benchmark by a bit over 2.5%. So, the track record is pretty solid. So the fund represents our preferred fixed income play, since it combines the safety of investing in high quality government and semi-government bonds, and the fund's also got proven risk management strategies to protect investors from fluctuations in interest rates, which importantly, important when we're sort of putting it in that cash bucket and having that liquidity to access those funds down the track if you need it, is really important. So that's really the bit I wanted to cover off this morning. I guess the real takeaways are that we've now got access to the Macquarie Accelerator account, which gives us a boost to the funds that are in cash, and we'll have a note out shortly in terms of the process to go about that. And I'll now hand over to Laura and Alex to talk a little bit about what they do in their fund. Thank you.
Great, thanks, Mark.
I'll just stop sharing.
Okay.
There you go.
Thank you. So hopefully you can see my screen now.
Yep.
We can.
Excellent. Okay, so I thought we could begin with a quick business overview. We were founded in 2008 by 4 principals, and those 4 principals are still with Ardea today. We now have 17 billion in assets under management, and our biggest clients are superannuation funds, insurance companies, government entities, but we're also rapidly growing into the retail market as well. We implement a specialist pure relative value strategy. And that means that we seek out exposure to mispricing between securities that are very closely related to each other and have the same exposure to the same market risks, but they're priced differently. And these strategies are very lowly correlated with bond and equity markets, because that mispricing that we seek out exposure to is not correlated with bond or equity markets either. Now, other relative value strategies involve taking macro directional bets. So for example, in a previous role, I headed up the interest rate quantitative strategy team at CBA. And there we published research which identified trades that did things like going long Aussie and short USD. And these are relative value strategies and they are relative value trades, but they leave the investor with exposure to market risk and market beta. In terms of our ownership structure, we are majority owned by employees, and we think that that's very much aligned with the objectives of our clients. So solid long-term performance, good solid long-term performance is not only good for us, but it's also good for our clients as well. There's a minority stake owned by Fidante, and Fidante provides us with all of the back office, so operations, legal, etc. They also provide us with marketing and BDMs, and that means that they look after all that stuff, and then we're left to do the investing, which is what we're good at. So if we move on to the next slide, so this is the team structure, and you can see that there's 4 broad functional groups. You'll also notice that for a fund of our size, that the portfolio management team is quite large, and there's a reason for that, and it's because this is a very resource intensive strategy. So we require quite a bit of dealing resources, and then quite a large portfolio management team as well. The other difference with respect to our portfolio management team is that we are structured so that there is a one team, one portfolio approach. And this is in contrast to many other portfolio managers or fund managers, I should say, where there's 1 or 2 lead PMs for each fund or portfolio. And this can often create competition amongst portfolio managers. And we wanted to negate that. And so we made sure that this structure was such that everybody had the same goal with respect to the portfolio management. It also means that it mitigates any key employee risk, so that if any portfolio manager does leave the team, that all of the ideas are institutionalized and can stay within the fund. So I look after the research team, and the research team has 2 functions. So the first is that we developed trade ideas for the portfolio managers, and we do that by building tools and technology using quantitative techniques like machine learning and statistics. And this brings a lot of scale and robustness to the trade idea generation process. We also publish thought leadership pieces on portfolio construction and research, asset allocation research. And you can find a lot of that research up on our website. Today we have Alex Stanley, who'll be presenting on our attribution and performance, as well as giving you a market backdrop and to talk about some of the opportunities going forward. Alex is a recent joiner, and he joins us from NAB, and he was a very highly rated interest rate strategist over at NAB, so we're very, very lucky to have Alex join us. The more recent team is the risk and analytics team, and the reason that we developed that team was because previously the risk model sat with Ben Alexander, who's our CIO, and by removing the risk model from that team and placing it with the risk and analytics team, we've now freed Ben up to focus more on the trade ideas and that kind of thing. It's also best practice to make sure that you have the risk model sitting outside of the portfolio management team as well. So I thought the next example that we could go through is a trade example, and I think this will really help to cement the relative value approach that we take. So I mentioned that relative value strategies involve seeking out exposure to mispricing between securities that are very closely related to each other, but are priced differently. And here we have a bread and butter example. This is a bread and butter trade that we implement in the portfolio very, very often. You can see on the left-hand side that we plotted the price for a 10-year government bond price and the 10-year interest rate futures contract over time. Now, these 2 securities are very closely related to each other, and they're exposed to the same risk, which is interest rate risk. But over time, we've noticed that they are priced differently. And the reason that they're priced differently is because there's very large institutions with different demand levels for those 2 different securities. And a really good example is insurance companies and hedge funds. So insurance companies are legislated to invest in government bonds. So that means that they have to invest in government bonds, whereas hedge funds prefer to invest in interest rate futures because they're more liquid and they take up less space on their balance sheet. Now, over time, we have noticed that those 2 securities price differently to each other, but that in and of itself does not necessarily represent a buying opportunity or a relative value opportunity. What does present a relative value opportunity is when there's a distortion or a deviation that's significant enough from the previous pricing relationship, and that then does present a buying opportunity. So in that case, we might identify the 10-year government bond to be trading much cheaper relative to the 10-year interest rate futures contract than it has been historically. So we would purchase the 10-year government bond. Now, if we were to simply purchase the 10-year government bond because it was cheap and hold on to it, we would be exposed to the mispricing, but we would also be exposed to market risk. So the next thing that we need to do is we need to buy the 10-year government bond, sell the 10-year interest rate futures contract against that government bond. And then what we've done is we've stripped out any of the market exposure and we've isolated the mispricing. And so that way we're only exposed to the mispricing and we won't be exposed to any market movements or interest rate movements. Now, the last step is really important, and this is where we package all of the different trades that we've identified into the portfolio in such a way so that each trade contributes only a modest amount to volatility at the portfolio level. And this means that we maintain diversification. So on the next slide, we talk about how we construct the portfolio in a little bit more detail. And there's two really important concepts that are involved in our portfolio construction process. The first is diversification, and that means that we need to make sure that all of the trades that we have in the portfolio are very lowly correlated with each other. And in that way, they're only contributing small amounts to the total portfolio volatility. However, this kind of strategy works during benign times or really good times in markets, but during risk-off periods, so crisis periods or really volatile markets, that diversification seems to dissipate. And that means that the correlation between trades and also other assets starts to increase and approach 1. So that means that we also need to introduce another concept, and that's known as risk balance. And this means that we also identify trades that do really well in risk-off periods. And the way that we identify those trades is we perform a series of backward-looking and forward-looking scenario and stress tests. And so that way we're able to identify trades that do well in risk-off periods, and we make sure that we include a healthy allocation to those trades within the portfolio. So you can see in the chart on the left-hand side that the trades that do well in risk-off periods, so in crisis periods or in more volatile times, they have a higher allocation than the other trades. And the reason for that is because 1, they provide protection to the portfolio, but 2, often it's more difficult to identify those types of trades. And so we prefer to load up on those trades a little more than we do with the other trades. So now I'll move on to what's in the portfolio. So this gives a snapshot of the exposures and the allocations that we have in the portfolio. And you can see that in the box on the far left, that our exposures in terms of bonds are limited to government bonds and semi-government bonds. In terms of our rating exposures, there's no credit exposure, and so you can see that the credit ratings don't fall below AA, and that's really important. In terms of the regional exposure, we are a global fund, which means that we have exposure across global interest rate markets. And while the exposure here suggests that we predominantly invest in Australia, these exposures can swing actually quite wildly around on a month-to-month basis as we seek out opportunities in global rates markets. It just so happens at the moment that we're seeing quite a few really fantastic opportunities in the Australian market, and that's why the exposure there is biased towards Australasia. Now, Mark mentioned that we are very lowly correlated with duration and interest rates. So you can see here that the 12-month average is 0.2 and since inception is 0.1. And that is indeed an extremely low interest rate exposure, especially if you can consider that the duration on the Barclays Global Ag Treasury Index is around about 9 years at the moment. And you know, that index is really meant to be representing the risk-free asset class. And so our exposure is materially less than that index is. So in summary, we only invest in the highest rated, most liquid government bonds and their associated interest rate derivatives. We also invest in inflation-linked bonds. So there's an inflation exposure component, and I'll explain a little bit more about that later on. And we also invest in money markets and cash. So there's zero credit exposure. We have negligible duration risk, It's daily liquid. So even over the March crisis, we maintained that daily liquidity. We don't have any emerging market or foreign currency risks. So we hedge out all of our currency risk, and we have an extremely deep opportunity set. And the reason for that is because global government bonds and their associated interest rate derivatives markets are much, much larger than equity markets, and they're often much more liquid as well. Okay, so this slide gives a really great summary of how we use derivatives in the portfolio. And I think derivatives often get a bad rap. So sometimes if used improperly, they can introduce significant risk into a portfolio. However, we use derivatives purely for defensive purposes. And we focus on the purchase of options. So when we buy options, we're only ever exposed to the very small premium that we paid for those options, but then we're exposed to unlimited upside potential. So there's an asymmetric payoff profile that you get from investing in options. You'll also notice that there's a minimum of 90% exposure to government bonds. So we have to have a minimum 90% allocation to bonds as a percentage of the net asset value, and then the other 10% can be made up of derivatives. So derivatives are purely implemented for protection purposes, and a lot of our other segregated mandates that have more stringent derivative controls, which means that we're not allowed to use as many derivatives, have over time noticed that other strategies have a much more volatility controlled return profile if we're permitted to use more derivatives in the strategy. And then over time, those clients have asked us to relax those constraints as they see how beneficial it is to be using options and derivatives in the strategy. So now I'll move on to the performance table, and then I'll hand it over to Alex. So the performance targets are cash plus 2% and CPI plus 2% for the return target. And the volatility target is a rolling 2% over 2 years number. Now you can see that over all of the horizons here, including the since inception number, has all exceeded the cash plus 2% or CPI plus 2% target. And you'll also notice that over the 1 year horizon and the 3 year horizon, that the return has really started to spike. And there's a couple of reasons for that. One is that over the last few years, we've been recruiting more global experience into the team, into the portfolio management team. And that's meant that we've been able to really increase our alpha opportunity set. The other reason is that we've also experienced extremely volatile interest rate markets over the last few quarters and over the last year. And those types of environments are where we do really well. And the reason that we do really well over those types of environments is because we've implemented the protection strategies that focus on utilizing options, as I mentioned on the previous slide. So rather than seeing volatile markets as a threat, we see them as opportunities because they present distortions and big changes in money flow and mispricing between securities that we can then capitalize on. It also means that when markets are extremely volatile, the value of those interest rate options that we have purchased increase significantly in value, and so they tend to increase meaningfully to the portfolio return as well. Now, I mentioned that the return target involved a CPI target, and the reason that we have a CPI target is because a lot of our clients have a retirement liability that they need to fund. And so that means that we maintain exposure to inflation-linked bond markets, and that's a structural exposure that we keep within the portfolio consistently. So we never try to time the exposure to these markets. We just keep that exposure on because we don't want any of our clients to be suffering from unexpected inflation increases and therefore the erosion of their purchasing power as well. You'll also notice that the volatility target has been met over all horizons, including since inception. And you'll also notice that again, there's a little bit of a change in terms of the profile over more recent horizons. You can see that the volatility number has started to decline. And that's kind of in contrast to what you might expect for a bond fund, particularly since we've seen the most volatile bond markets in history. And again, the reason that we've been able to exhibit these low volatility numbers is because we implement these option strategies, which provide a lot of protection to the portfolio. So now I'll hand it over to Alex, and he can talk about the attribution and performance. So over to you, Alex.
Great, thank you, Laura. As Laura's outlined, Ardea's returns have been stable and positive over time, exceeding cash and with low volatility over the long run. Slide 12 shows some detail of our attribution. So, at Ardea, we understand that fixed income isn't always the most easy to understand market, and a strategy like ours isn't always the most easy to understand. But what I think this table does quite nicely is it splits the sources of return down and shows how they've performed over time. So if you were to think about, like an active equity manager, for example, they'll often talk to their investors about sector rotation and different market conditions being more conducive to different types of investment strategies. And the same sort of principle applies to us, but as Laura has outlined, we don't take market directional bets. It's still the case, however, that different market conditions will affect different types of our, or different aspects of our strategy in different ways. And so the simplest part of our attribution, the simplest part of our kind of categories of return is this carry income line. And that those numbers you can see they've trended down over time. This is most closely related to what you would get from a conventional cash manager. And you can see that return over the last year has been significantly less than it was over previous years. And the rest of the strategies here, I'll talk to in a little bit of detail about what they are, but importantly, I'll give a little bit of context to how they've performed. The interest rate strategies, the volatility strategies, and the inflation protection. And over time, these strategies have performed differently depending on market conditions. And they're all actively managed, particularly the RV interest rate strategies and the volatility strategies. And in terms of talking about market themes, we all know that since March this year, the world has changed, and it's changed in a big way with COVID. And so I want to focus on how Ardea's performance and how these different categories of trades have performed during that period and since, because I think that's a real test for for any fund manager really, but for fixed income, is it providing the investor with that stability? Is it providing investor with that diversification? Is it maintaining liquidity, and is it maintaining positive performance? And we think the Real Outcome Fund has done all those things. And in terms of the first one, RV interest rate strategies. A good example of this is the kind of very conventional type of trade that we do, which is buying one security that's mispriced relative to another. Laura gave a great example before of bond futures versus physical bonds. And this is a very common type of trade that we have, and these are typically very low volatility. So in the first quarter of this year, we had a number of these strategies on in the Australian market, but also in other markets. I'll stick with just Australia just for ease of example. And a number of these government bonds we were long, and we were short and we were short the futures contract. So we were positioned for a performance of physical bonds versus futures. And they were performing in their normal low volatility way right up until the second half of March, when you got this massive shock to global markets. This is one of the first times ever that some of our very experienced portfolio managers have seen liquidity significantly dissipate in every aspect of financial markets. So even government bond markets were experiencing a significant amount of disruption. And what that led to was these physical government bond trades versus futures performed worse in that period of time. Since then, they've rebounded and contributed positively to performance. So why have they turned around? One reason is the impact of central bank intervention. So central banks understand, and they especially learnt their lesson from the GFC, that government bonds and interest rate markets are the plumbing of the financial system. You need to get that aspect of your policy right, and they went hard and they went early, and they arrested that decline in market liquidity. And also what we saw was investors fleeing other assets like equities and credit and seeking to move into the safety of government bonds. So initially these physical bonds cheapened, and then they appreciated in value relative to futures as markets normalised. And going forward, we think there's a lot of going to be continued good opportunities in this interest rate strategy space. So the performance was not as great from this category during the peak of COVID, but it's since rebounded quite strongly. And the reason we think there'll be continued positive performance there is the change in the supply-demand dynamics in bond markets. So supply-demand conditions affect investors the same way in government bond markets as they do in other markets. On the supply side, we know that governments everywhere in the world are implementing enormous amounts of stimulus. So across all developed economies, it's something like 20% of global GDP. Simply huge numbers. The Australian government's issuing more government bonds this financial year than the entire size of the market was about 7 or 8 years ago. So we're talking huge, huge numbers. On the demand side, you've got the private investors who need an appropriate return in order to take the duration risk. And then you've got the central banks that are basically price insensitive buyers. And in Australia, for example, the Reserve Bank buys 3 years. The first speaker today, Mark, mentioned that they have that three-year target. They're locking down one part of the curve, but they're not locking down the rest of the curve. And that's where the rest of the market exists. So there's a lot of really attractive interest rate relative value strategies at the moment where new issuance is coming at a discount to the existing curve. It's leading to opportunities where you can take only a small amount of incremental extra duration risk and earn a lot of extra pickup. So an example of this is the government issuing a 4 or 5 year bond at a steep discount relative to a 3-year futures contract. And so what we can do is eliminate the risk of rising interest rates through the futures and other derivative markets and capture that physical demand, physical bond premium. And so we're not betting on direction of markets, but we're able to lock in an RV opportunity. And so I want to talk now about that volatility line. So that has behaved in kind of the opposite way to the RV interest rate strategy. So during the height of COVID, we owned a lot of positions that were positioned for what we call long volatility. So these are trades that benefit or investments that benefit when you get an increase in market volatility. And so Laura talked before about this concept of risk balance, and this is how risk balance is achieved, having these trades in the portfolio that benefit when things go wrong. And, we understand at Ardea that, these things are inherently difficult to predict. So it's about having enough of these strategies in the portfolio, and it's about having a good understanding of scenario analysis and knowing that when things go wrong, these trades start to pay off. So it's not that we predicted that COVID would happen, it's that we always have a good risk balance in the portfolio for when these situations arise. And, looking forward, so while those volatility strategies did really well during the height of COVID, as volatility has since come down, they've been less of a driver of performance relative to the RV interest rate strategy. So they've kind of had the opposite path, which has provided our portfolios with good diversification. So, looking ahead, you don't have to think too hard about what could make volatility in the markets go up again. So if you look at the broad arc of what asset markets have done over the last couple of months, they're, reflecting a lot of big assumptions about, the COVID vaccine, about not needing to worry about the outcome of the US election, which is a very big bet. When do governments and central banks start to wane on their massive support for economies? These are just a couple of examples of the big questions that could turn out to be answered in a way that isn't commonly well understood by investors at the moment, and that could lead to future volatility. And so having that volatility trade exposure within the portfolio protects us for when we do get another one of these big volatility spikes. And the other line that's left to discuss here is the inflation protection. So as Laura outlined, our goal is capital preservation. Inflation protection structurally within the portfolios gives that protection against the real value of investors' cash. So you can see that that 3-month performance has been very, very strong from the inflation protection component. And so you might ask yourself, why is that? We're in the midst of a global recession. Why would inflation protection be performing well? And this is all about this disconnect between what we experience in the real economy as inflation right now and the market instruments for inflation, which are inflation-linked bonds, which are reflecting investors' expectations for inflation over the next 5, 10, even 30 years. And so we maintain positioning across that whole curve to achieve that inflation protection on investments. And so over the last few months, investors have said, well, at the height of the COVID crisis, everyone thought, well, inflation is going to be really, really low. This line went down, and it's since rebounded strongly because investors are now starting to question, if governments do keep this fiscal support alive for a long time, if central banks continue to cross all previously thought of barriers to easing, negative rates, buying lots of government bonds, what could this mean in the long run for inflation? And the answer is we don't really know. Economists are not very good at forecasting this stuff, but the market has to set a price for it. And so there's this really big disconnect between what the long-term inflation outlook priced by the market is, which has recovered more in line with what you see in the equity market, and the short-term reality, which is a recession and very low rates of inflation. And how that tension is resolved over the next few years will be very interesting to see, and will have a significant impact on fixed income markets. But by maintaining that inflation protection, we know that we're protected against a situation where the upside comes through, where inflation does start to pick up because governments are willing to underwrite all kinds of things that they never used to, and because central banks are willing to keep rates at zero. Turning to the diversification aspect, over on slide number 16, thanks, Laura. This chart here just illustrates some of the risk characteristics of the real outcome fund. So this shows how our pure relative value strategy has been a true diversifier to the broader universe of bonds and equities. So on that left-hand column are a range of global and Australian fixed income and equity indices. And those correlation numbers show you how the real outcome fund has, how close the relationship is with these broader indices. And you can see all of those numbers in those correlation columns are closer to 0 than they are to 1, which shows, and importantly, if you look at the negative months column, when broader government bond and credit bond indices were going down in price, Ardea was not following them. So it's maintained that low correlation. And that downside capture column on the right-hand side shows that returns have been positive when these markets have experienced their worst losses. So it's about being it's about the fixed income investment in real outcome, providing that buffer against, or that protection against weakness in these broader markets. And this is, I think, now more important than ever, because if you think about where government bond yields are, record lows, where equity markets are, depending on which index you're looking at, in the US, near record highs. In Australia, they've experienced very strong bounce from the March lows. There's never been a bigger disconnect. And if you think about a conventional government bond strategy, just owning a lot of government bonds and relying on them to protect you when equity markets fall, well, if they're already at really, really low yield levels, unless you believe that central banks are going to go massively into negative territory with the cash rates, then there's only limited room that conventional strategy can rally, those bonds in the conventional strategy can rally and protect your portfolio. So it's really important to have a source of fixed income protection that doesn't rely on yields going down further to provide that buffer. And that's where the real outcome fund is so advantageous. Over on slide 17, this set of numbers shows how the real outcome funds performed in two very significant adverse market environments. And I think, again, coming back to this COVID crisis and what that has done to markets, I think that was a really important test. And those two columns on the right showed that even some of the most traditionally well-protected markets, like government-only global bonds, experienced significant losses during that period. But the real outcome fund was able to maintain positive performance. It was able to maintain low volatility in its returns, and it was able to maintain daily liquidity. And that diversification aspect was maintained as well. So we think that was an important test for the objectives of the fund, and on all of those, returns, volatility, liquidity, and diversification attributes, performance has remained strong. And given the uncertain nature of the economy at the moment, and given where a lot of assets are priced, we think that maintaining that diversification is really important. So I'll leave it there and pass it over to the moderator of the presentation if we have any questions.
Fantastic. Thank you very much, both Laura and Alex. You explained some what can be quite complex scenarios very well, and I'm sure that clients have got a lot of value out of that. And again, Mark, thanks for, I guess, wrapping it all up into a nice package to understand how the different parts work together for our clients. Now, luckily, we've got a question that's come through from Satish, and the question here is that for our call accounts, what are our views on UBank? Can get 1.6% on call provided there is a linked USaver. It only applies to non-business accounts, so not SMSFs. It may be useful to park your pension better than CMAs. What are our views? And then that's followed by another question from Satish. So we might throw this one either to Mark or to Laura or to Alex. Are the Ardea investments covered by government? Cannot now recall the guarantee security amount. Is it 250,000? So maybe Mark, if you can cover the first question around the UBank side of things, and then maybe Laura, you can jump in, or Alex on the second part.
Yeah, sure. So look, I guess the cynical answer to that question is the devil's in the detail. And I guess, for a lot of clients, we've used Australian money markets to access higher interest rates for term deposits and the like, which is there's no issues with that. But often you'll see an attractive rate and say, oh, that's good. But, oh, that's only available if I'm if it's held in my own name, or it's not available in a super fund, but, or a trust or a company. So, and you touched on that, the question touched on that aspect. And I guess the other thing is we also talk to people who've got money in accounts where, you need to complete a certain number of transactions in a month in order to maintain a higher rate. The bottom line with these things is that they're all fine as long as there's nothing wrong with having your personal money in a UBank account or a member's equity account or these things. I think as the question sort of highlighted, or follow-on question about the government guarantee, a lot of these ADIs, approved deposit institutions, they are covered by that government guarantee up to $250,000 per investment. So, yeah, if we're able to maximise those things in a personal portfolio of cash, then that makes absolute sense.
Yeah. And so just on that point, I don't think we've got any other questions, and we're running on time today. So absolute credit to all of our presenters. I usually manage to run over time, so we've done very well. But I think the point that you make there, Mark, is super important. Everything we've talked about today is taking, I guess, a bit more of a macro or general view about how we're thinking about trying to maximise outcomes for clients. But it's really the hard work gets done by the advisory team. When they sit down, they look at specific personal circumstances, which is what we'll do throughout the course of later this week and early next week as we move to work out how best to apply what we've talked about today to individual portfolios. But In the absence of there being any other questions, I really want to thank all of our presenters today, and I can't sort of overstate this more, but this is a difficult area for people to understand, and I think what has been discussed is very beneficial to understand how Ardea has performed in different market scenarios. I think track record, although you can't rely on it, is also something that does go to credibility, as does sort of tenure of managers, and the team at Ardea have been around for a long time. So look forward to continuing to work with Ardea, looking at the Macquarie situation for different clients, but importantly applying it as appropriate. So thank you very much to everyone who presented. Thank you, Satish, for your question. We always like a good challenging one. Yeah, look, we hope everyone has a fantastic day and look forward to speaking shortly. So thank you to everyone again.